We have two legendary investors from Silicon Valley talking about hundreds of billions of dollars worth of AI capex spend. What else would you rather watch? Check this out.
I would say, like, you'd have to be a fool not to notice that these numbers you're talking about are so remarkably unprecedented from anything we've ever seen before. They are massive. I've talked about, to see the Mag 7 go from being massive cash producers to where many of them are taking the majority of their free cash flow into capex. It's totally new, and clearly everyone believes that this wave is maybe bigger than the previous waves we've seen that have led to so much value creation. So all that's happening. I like to believe that it's okay to recognize that the market's great and still think that these transactions shouldn't happen this way. And I'm able to keep both those things in my head at the same time.
I think it's a super fair point. By the way, you just mentioned it, so we'll include this chart. This is Mag 5 capex as a percentage of their operating free cash flow bill. And if you look at it in 2025, so that's this year, they'll spend about 66% of their operating cash flow on capex. Right. And if you look at the consensus forecast for their capex relative to their operating cash flow, this is the peak, around 66%. It has it going down to about 45 or 50%. Now, embedded in there is they're going to keep growing their operating free cash flow at 15 to 20% a year, right? So there's still room for them to grow with that coming down. But I think that is another thing to keep your eye on. How much are they spending? And by the way, just give you an order of magnitude, Bill. In 2023, their total capex was $156 billion. And this year, it's $379 billion, right? So radical step up, in your point's a good one. And just remember, a couple years ago in 2022, when Meta stepped up their capex spending on Reality Labs, the stock got obliterated because people said, what the hell are you doing? This is all about free cash flow per share, including myself. I was saying, let's get fit here. Let's drive more free cash flow out of the business. So much so that the CFO sent me a hat that says free cash flow, right? So they got real about free cash flow, but there's a difference between investing that free cash flow in data centers and AI than there was in Reality Labs. As an investor, let me just tell you my own perspective. The reason Meta stock's doing great, notwithstanding going back to high levels of capex spend, is because now the investors understand it and believe in it. We're seeing the benefits, right, in the earnings of the business. They're growing the earnings of the business. They don't have to hire a lot of new employees. And so it's fundamentally different than the capex that was going into Reality Labs, where investors were saying, well, hold on a second, we're going to spend $100+ billion over the next 5 years. We don't even know what we're building, right? We don't know what it will be worth at the end of the day. So I think for now, at least, there's enough belief in the byproduct of generative AI, because people are using ChatGPT, they're seeing the utility in the enterprise, that they're going, that they're willing to tolerate these companies giving over half of their free cash flow into these build-outs.
I do think another dynamic is the race condition created by the competitive dynamic. And it appears from where I sit, and you don't need to comment because you're an investor and maybe have more information than I do, probably have more information than I do. But it appears to me that OpenAI, through all these partnerships and announcements, is trying to create escape velocity, and that could be against the model providers. It could be against a hosting provider, depending on how you think the market plays out. It could be on the consumer side. It could be on the API side. But it creates an interesting stress test for anyone else in the ecosystem to say, are you going to lay chase? Because of all the numbers you laid out there, they're gargantuan. And it'll be interesting. That's my opinion. It just feels like they're daring people to follow them, and I suspect a bunch don't. It may work.
Hans, what an incredible chart Brad Gerster did just share. It showed capex spending from Mag 5 ramping up to over $500 billion. My question for you is this going to be most of the AI capex spending pie, or do you think there will be a huge surge coming in from other companies and governments around the world? OpenAI is clearly investing in a big way in the space, so maybe excluding them.
Well, if we want to think about where all of this demand is going to be coming from for continued build out of AI compute, I think there are 3 constraints that we should actually think about. And those are going to be capital, talent, and energy. And so anyone who has the correct combination of capital, talent, and energy is definitely going to be wanting to build out as much AI compute capacity as they can right now. And obviously, all of the hyperscalers have all 3 of those things. They have great businesses that throw off free cash flow. They also have spent a lot of time developing large amounts of AI talent in-house, and they can pretty much acquire the energy that is necessary to build out the compute that they have actually put in their roadmap. So then when you're thinking about the incremental entities, companies, countries, whatever it is that are actually trying to participate in this AI build out, then it gets a little bit more interesting. Obviously, as you mentioned, OpenAI is going to be one of the big players. Then the other one that you didn't mention that I think will be a major one is xAI. Elon has a great ability to acquire talent. They've got great models. They have access to unique data. They seem to be doing pretty good on energy so far. And based on the industry scuttlebutt that's going around, there's probably also going to be deals with sovereign wealth funds in the Middle East that are going to help continue to fund that build out as well. And so I would expect to see continued large scale build outs for xAI. The interesting thing about them, though, is that almost all of the big in-house build-outs that they do are focused specifically on training, and they actually outsource most of the inference to other companies like Oracle, for example, which of course brings me to the other group of big players in the space that are going to be adding a lot of AI compute capacity, and that is these new neoclouds, companies like CoreWeave, obviously Oracle, as I just mentioned. And the interesting thing about these companies is that they owe a lot of their success and existence to pullbacks in investments by the hyperscalers or under forecasting, whatever you want to call it. That, for example, Satya Nadella and Microsoft last year were getting a little bit nervous about the amount of capex that was going into the ground for AI data centers. And Sam Altman was obviously pushing ahead and trying to get as much capacity as he could get. And Satya was pulling back. And so this kind of created some tension. And so then when you fast forward to this year, what we've seen is that Microsoft did end up needing a lot of that additional demand. And because they didn't build it themselves, they've actually been turning to CoreWeave to be able to either rent or lease back this capacity that they didn't build out, which seems like a trend that is going to continue to play out, that I think Microsoft actually likes to allow Oracle and CoreWeave and these other companies to take on some of the risk of building out this last block of incremental GPU infrastructure that needs to be installed in order to meet current demand, but is potentially on the chopping block to be the first capacity to actually go idle in the event that we actually do see a pullback in demand. And so this is going to be one of the main points of argumentation moving forward that will determine the answer to the question, where is the majority of this demand going to be coming from in the future? Is it going to be coming from hyperscalers, or is it going to be coming from other players? Well, so if you say that the majority of the demand is going to be coming from these other players like neoclouds and sovereign AI in countries that are heavily interested in building out sovereign AI, then the percent that you would actually allocate between those different segments is going to depend on how much incremental demand do you actually see materializing beyond what the hyperscalers are already forecasting. If the hyperscalers end up being 30% conservative or 50% conservative or 70% conservative, and then the neoclouds are actually able to come in and fill that in, then it could significantly shift the balance between who is actually adding more capacity. And remember that I think NVIDIA is heavily incentivized to support the build out by these neoclouds like Oracle and like CoreWeave, because it allows them to sell full data center solutions, not these piece by piece bespoke solutions that they tend to sell more into each of the individual hyperscalers that have a lot more constraints around what parts of NVIDIA's technology that they are adopting. And then to bring it back to the framework of capital, talent, and energy, for the neoclouds specifically, these are a group that they have much more limited access to capital. It involves a lot more debt financing than the hyperscalers, which makes their cost structure a lot more sensitive to getting the depreciation schedule right. How many years can they anticipate making money from a GPU that they buy today? Is that going to be something that they can continue to actually operate profitably for 1 year, 5 years, 6 years? 3 years? I think 6 years right now is the standard. I think that's what people are expecting, and that's the structure that a lot of the deals that are happening currently are being made under. And so if we see significant changes that throw that into doubt, then that is something that would limit their future ability to do debt financing for a continued build out. The other thing is that these neoclouds definitely have more limited access to talent, but it is different talent that these people need, since they're not necessarily the model providers or doing the fundamental research. The talent that they need to assemble really is the nuts and bolts talent of getting buildings into the ground, getting energy infrastructure built up, doing all of the installation of these systems, bringing in cooling, bringing in water, all of those sorts of things. And at least for the time being, this is a little bit more accessible, although as the total size of these deployments grow, that will become more and more of a constraining factor. And then finally, as I mentioned earlier, there's going to be a large cohort of countries that are very interested in developing sovereign AI. This is going to be something that is more bottlenecked by talent. I think there's a lot of sovereign AI plays where energy is going to be plentiful, and potentially capital will be easy for them to access. But actually getting the people in the right place to do that build out will be a little bit more of a challenge. And so I think the specific places that you see doing these big sovereign AI deals first will be the ones that have the most excess capital and the most excess energy, so that they can then use the surplus that they have of those two items to be able to underwrite the excessive wages that they're going to have to pay to actually execute the rest of the build out. And then between all of these things, it's going to be a much larger overall build out than people are expecting even now. That our need for AI infrastructure is just an exponentially growing need, and that's going to continue to outpace expectations for some time.
I want to take it back to Brad Gerstner's chart on Mag 5 AI infrastructure spending. As we go into the second half of this decade, it showed capex spending decelerating, and also the percentage of free cash flow spent on AI infrastructure decreasing as well. Now, I'm wondering if this actually makes any sense. We're in a once-in-a-generation technological shift, which is opening the door to new products, new opportunity to give value, and new opportunities for revenue. This tech is only going to be better in 2 years' time, in 3 years' time, in 4 years' time. Does it make rationale for that investment to be slowing down when there's such an enormous opportunity ahead?
Well, let's remember that the chart that Brad Gerstner is showing there is just for the Mag 5, so the hyperscalers plus NVIDIA really. And so it is completely feasible that overall AI capex spend by the entire market does continue to grow, even if the hyperscalers were to level off. And in the potential scenario where they allow Oracle and CoreWeave and the other neoclouds to actually build out additional capacity, Grok would be another one that I think you're going to see a lot more of here in the near future. Grok with a Q, that is. So anyways, yeah, those people could continue to grow even if we do see more restrained spending continuing by the hyperscalers. But even in a scenario where all those other players are growing massively, I don't actually expect the hyperscalers to pull back on capex spending growth anytime in the near future. You have to remember that all of these companies are in somewhat of an arms race with one another. Microsoft, Meta, Amazon, and Google all know that it would only take a couple of years worth of poor choices in the highly competitive and rapidly transforming sector of the tech economy that they exist inside of. And so they can't really allow any of the other ones to get too far out ahead of them in terms of build out, because that additional infrastructure can be used to either accelerate progress at the frontier of model development or to serve better and better models to customers that they can use to then drive revenue or capture market share. And while a lot of people accuse Jensen of just talking his book when he tells us that we're going to need exponentially increasing amounts of compute over the next decade, we also have to sit back and recognize that he's actually foreseen what was coming sooner and better than almost anyone else in the industry. And if he is to be believed, we're only at the very beginning of a huge super cycle that has many years to go and will see us reaching trillions and trillions of dollars worth of annual spend on infrastructure build out, which is many times higher than what we're seeing today even. And so if you combine those prognostications by Jensen about what the future looks like with the evidence that we see coming out of OpenAI and their rapidly growing number of weekly active users and their parabolic revenue ramp, we do see the potential for massively growing demand for these AI-powered products and services that can more than support increased capex spending into AI infrastructure build-out.